I've watched people repeat the same mistakes for decades, and the root cause is always the same. I've seen brilliant minds fail because they overlooked one simple truth. It is a paradox of the highest order that the very intelligence that brings success in so many other fields can become the greatest liability in the world of investing. The smartest people, the ones who can solve differential equations in their heads or design elegant bridges that span miles, are often the most susceptible to the most ruinous of financial errors. They believe that their intellect grants them an edge, a predictive power that can outsmart the market. They are wrong. The market is not a puzzle to be solved. It is not a game of chess where the most intelligent player wins. It is a complex, adaptive system, a chaotic dance of fear and greed, of information and noise, and it does not care how smart you are. In my years, I have seen more fortunes lost to intellectual arrogance than to any other single factor. The mistake is not a lack of intelligence, but a misapplication of it. It is the belief that you can predict the unpredictable, that you can control the uncontrollable, that you can impose your will upon the market. This is the biggest mistake smart people make in investing. And today I will show you how to avoid it. The first fatal mistake is the illusion of control. The human mind, particularly the intelligent mind, abhors a vacuum of causality. It seeks to impose order on chaos, to find the signal in the noise. This is a valuable trait in science, in engineering, in medicine, but in the market, it is a siren song that leads to ruin. I once knew a physicist, a man of breathtaking intellect. He could describe the universe in the language of mathematics, from the dance of subatomic particles to the grand waltz of galaxies. He saw the world as a series of deterministic equations, a clockwork mechanism where every effect had a discernible cause. When he turned his attention to the financial markets, he saw another clockwork to be understood. He spent years developing a model, a magnificent edifice of differential equations and stochastic calculus. It was a thing of beauty, a testament to the power of the human intellect. He believed he had found the hidden order of the market, the secret rhythm that lay beneath the surface of chaos. He began to trade, and for a time he was successful. His model seemed to work, predicting the ebb and flow of prices with uncanny accuracy. His confidence grew, and with it, the size of his bets. He was no longer an observer of the market, he was its master. But the market is a fickle beast. It is not a clockwork, but a living thing, a seething mass of human emotion. And one day, it did something that his model could not predict. It panicked. A wave of fear, born of a rumor, a whisper, a shadow, swept through the market, and his beautiful equations shattered like glass. He lost everything. His mistake was not in his mathematics. His mathematics was flawless. His mistake was in his philosophy. He believed that the market was a system to be solved, a problem to be answered. He failed to understand that the market is not a system of particles, but a system of people. And people are not rational actors. They are driven by fear and greed, by hope and despair. They are prone to panic, to herd behavior, to fits of irrational exuberance, to believe that you can control. This is the height of folly. The market is a river, not a reservoir. You cannot dam it, you cannot channel it, you cannot bend it to your will. You can only ride its currents, and to do that, you must first respect its power. You must accept that there are things you cannot know, things you cannot control. You must abandon the illusion of control and embrace the reality of uncertainty. This is the first step towards wisdom in the market. The illusion of control is not just about believing you can predict the market. It's also about believing you can outsmart it with complex strategies. I've seen brilliant quants, armed with the most sophisticated models, try to build trading systems that are supposed to be immune to market turmoil. They create intricate hedging strategies, complex derivatives, and layers of financial engineering designed to insulate them from risk. But they forget that every financial instrument, no matter how complex, is ultimately a claim on a real-world asset. And in a crisis, the correlations between those assets can go to one. The diversification that looks so robust on paper evaporates in a puff of smoke. The hedges fail, the models break down, and the illusion of control is shattered once again. The problem is not that these strategies are not intelligent. They are often brilliantly conceived. The problem is that they create a false sense of security. They lead you to believe that you have tamed the market, that you have built a fortress that can withstand any storm. But the market is not a fortress. It is a wild, untamed ocean. And no matter how strong your ship, you must always respect the power of the sea. The only way to survive is to be humble, to be adaptable, and to never, ever believe that you are in control. The second fatal mistake is overconfidence. It is a close cousin to the illusion of control, but it is a more insidious poison. It is the belief that your past successes are a guarantee of future performance, that your intelligence grants you a permanent edge. I remember a young trader, a prodigy from a top university. He had a preternatural feel for the market, a sixth sense for its movements. He made a fortune in his first few years, and he became a legend on the trading floor. He was hailed as a genius, a visionary, the man with the golden touch, and he began to believe it. He started to take bigger risks, to trust his intuition over his models. He believed he was infallible, that he could not lose. He was so confident in his own abilities that he stopped listening to the data. He ignored the warning signs, the subtle shifts in the market that his own models were screaming at him. He was convinced that he knew better, that his intuition was a more powerful tool than any algorithm. He was wrong. The market has a way of humbling even the most arrogant of its participants. A sudden, unexpected event, a black swan, swept through the market, and his carefully constructed portfolio, built on a foundation of hubris, collapsed like a house of cards. He lost everything and more. His story is a cautionary tale, a reminder that confidence is a double-edged sword. It is essential for success, but it can also be a fatal flaw. The moment you believe you cannot be wrong is the moment you are most at risk. The market does not reward confidence, it rewards humility. It rewards the willingness to question your own assumptions, to admit when you are wrong, to learn from your mistakes. It rewards the understanding that you are not the master of the market, but its student. You must never forget that you are fallible, that your knowledge is incomplete, that the market is always capable of surprising you. You must cultivate a sense of intellectual humility, a constant awareness of your own limitations. This is the only antidote to the poison of overconfidence. Overconfidence is particularly dangerous for the intelligent because they are so often right. In their chosen fields, their intellect has been a reliable guide. They have learned to trust their own judgment, and for good reason. But the market is a different kind of challenge. It is not a domain where intelligence alone guarantees success. In fact, it can be a handicap. The intelligent investor is more likely to be overconfident because they have a track record of being right. They are more likely to believe that they can outsmart the market, that they can see things that others cannot. They are more likely to dismiss dissenting opinions, to surround themselves with people who confirm their own biases. This is a recipe for disaster. The market is a vast and complex system, and no single individual, no matter how intelligent, can possibly have a complete understanding of it. There will always be information that you do not have, perspectives that you have not considered, and events that you cannot foresee. To be a successful investor, you must embrace this uncertainty. You must constantly seek out new information, new perspectives, new ways of thinking. You must be willing to challenge your own beliefs, to admit when you are wrong, and to change your mind when the evidence demands it. This is not a sign of weakness, it is a sign of strength. It is the mark of a true intellectual, one who is more interested in the truth than in being right. The third fatal mistake is the seduction of the narrative. Humans are storytelling creatures. We understand the world through stories, and the more compelling the story, the more we believe it. Smart people, in particular, are adept at both understanding and constructing narratives. They can see the grand vision, the sweeping arc of history, the disruptive potential of a new technology, but this strength can become a profound weakness. They fall in love with the story and ignore the numbers. I knew a historian, a brilliant scholar who could trace the rise and fall of empires with breathtaking clarity. He saw the world in terms of grand narratives, of technological revolutions and paradigm shifts. When he looked at the market, he saw the same patterns. He became enamored with a new technology, a company that promised to change the world. The story was perfect. It was a classic tale of disruption, of a small upstart challenging the established order. He invested heavily, convinced that he was on the right side of history. He ignored the financials, the burn rate, the lack of a viable business model. He was invested in the story, not the company. The story was beautiful, but the reality was not. The company burned through its cash, the technology failed to deliver on its promises, and the stock price collapsed. The historian lost a fortune, not because he was unintelligent, but because he was seduced by a good story. The market is not a storybook, it is a ledger, and the ledger does not care about your narratives. It cares about profits and losses, about assets and liabilities, about cash flow and burn rate. A compelling story can be a powerful tool for understanding the world, but it is a dangerous guide for investing. You must learn to separate the narrative from the numbers. You must be a skeptic, a cynic, a cold-eyed realist. You must demand evidence, not just a good story. You must ask the hard questions. What are the revenues? What are the costs? What is the path to profitability? If the numbers don't support the narrative is worthless. The most beautiful story in the world cannot save a company with a broken business model. Do not be seduced by the siren song of the narrative. Be guided by the cold, hard logic of the numbers. The power of narrative is not to be underestimated. It can be a force for good, a way to inspire and motivate, to create a shared sense of purpose. But in the world of investing, it is a dangerous drug. It can create a sense of euphoria, a feeling of certainty that is not justified by the facts. It can lead you to ignore the warning signs, to dismiss the naysayers, to believe that this time is different. But this time is never different. The laws of finance are as immutable as the laws of physics. A company that does not generate cash cannot survive. A stock that is priced for perfection is vulnerable to the slightest disappointment. A narrative that is not grounded in reality is a fantasy, and the market has a way of punishing fantasy. The dot-com bubble of the late 1990 seconds was a classic example of the power of narrative. The story was that the internet would change everything, that old business models were obsolete, that profits didn't matter. It was a compelling story, and it drove the market to dizzying heights. But it was a fantasy. The internet did change everything, but it did not repeal the laws of economics. The companies that survived and thrived were the ones that had a real business model, that generated real profits. The ones that were built on nothing but a good story were wiped out. The lesson is clear. You must be a student of history, but you must not be a prisoner of it. You must understand the power of narrative, but you must not be seduced by it. You must be a master of the numbers, not a slave to the story. This is the only way to navigate the treacherous waters of the market and emerge with your capital intact. The fourth fatal mistake is a failure to appreciate the mathematics of diversification. It is a concept so simple, so elegant, that its power is often overlooked, especially by those who believe they can pick winners. The intelligent mind is often a focused mind. It seeks to find the one right answer, the single best solution, the optimal path. This is a powerful approach in many domains, but in investing, it is a recipe for disaster. The allure of the concentrated bet is strong. The idea of finding that one stock, that one investment that will generate life-changing wealth is a powerful motivator. And for the intelligent investor, the belief that they can identify that one stock is even stronger. They do their research, they build their models, they convince themselves that they have found a sure thing, and so they put all their eggs in one basket. They scorn diversification as a tool for the masses, for those who lack the conviction to make a bold bet. They see it as a dilution of returns, a concession to mediocrity. They fail to understand that diversification is not about sacrificing returns. It is about managing risk. It is a mathematical necessity in a world of uncertainty. I once observed a group of engineers, all brilliant minds from a prestigious institution. They had developed a new algorithm for trading a specific commodity. Their backtesting was flawless. Their model showed astronomical returns. They were so confident in their creation that they pooled their life savings and invested it all in their new strategy. For a while, they were phenomenally successful. Their returns were the envy of Wall Street. They believed they had built a money machine, but they had made a critical error. They had mistaken a period of low volatility for a permanent state of the market. They had failed to account for the possibility of a black swan event, a sudden, unpredictable shock to the system. When that event came, a geopolitical crisis that sent commodity prices into a free fall, their undiversified portfolio was wiped out in a matter of hours. They lost everything. Their model was not wrong, it was simply incomplete. It had failed to account for the full range of possible outcomes. It had failed to appreciate the brutal mathematics of ruin. A concentrated portfolio, no matter how well researched, is a fragile thing. It is a tightrope walk without a safety net. A single, unforeseen event can lead to catastrophic losses. Diversification is the safety net. It is the mathematical recognition that the future is unknowable. It is the understanding that you will be wrong and that you must build a portfolio that can withstand your errors. It is not a sign of weakness, but of wisdom. It is the acceptance of humility in the face of an uncertain world. Do not be seduced by the siren song of the concentrated bet. Embrace the simple, elegant power of diversification. It is the closest thing to a free lunch in the world of finance. The mathematics of diversification are not complex, but they are profound. By combining assets that are not perfectly correlated, you can reduce the overall volatility of your portfolio without sacrificing expected returns. This is the magic of diversification. It allows you to have your cake and eat it too, but it is a magic that is often lost on the intelligent investor. They are so focused on finding the one perfect investment that they fail to see the power of the portfolio. They are so confident in their own abilities that they are unwilling to admit that they might be wrong. They are so enamored with the idea of the home run that they forget that the game is won by consistently hitting singles and doubles. The truth is that no one can predict the future. No matter how smart you are, no matter how much research you do, you will never be able to eliminate uncertainty. The best you can do is to manage it. And the most powerful tool for managing uncertainty is diversification. It is the only strategy that can protect you from the one thing that is guaranteed to happen, the unexpected. So do not be a hero. Do not try to be the next Warren Buffett. Be a humble, patient, and disciplined investor. Build a diversified portfolio of assets that you understand, and then have the patience to let it grow. This is the path to long-term wealth. It is not as exciting as the path of the gunslinger, but it is a lot more likely to get you to your destination. The fifth and final fatal mistake is the bias for action. The world rewards action. In most professions, the person who acts decisively, who makes things happen, is the one who succeeds. Smart people, in particular, are often people of action. They are driven to solve problems, to build, to create. They have a low tolerance for inertia. But in investing, this bias for action can be a powerful enemy. The market is a noisy place. It bombards you with information, with opinions, with a constant stream of stimuli that demand a response. The temptation to act, to do something, is immense. To sit still, to do nothing, feels like a dereliction of duty. It feels like you are missing out, that opportunities are passing you by. And so you trade. You buy, you sell, you tinker with your portfolio. You are constantly reacting to the noise, convinced that you are adding value. But more often than not, you are simply generating transaction costs and taxes. You are churning your portfolio, not improving it. I knew a surgeon, a woman of incredible skill and decisiveness. In the operating room, her ability to act quickly and precisely was the difference between life and death. She was a master of controlled, decisive action. When she brought this mindset to the market, it was her undoing. She could not sit still. She saw every market fluctuation as a problem to be solved, a situation that demanded a response. She was constantly buying and selling, convinced that she was outmaneuvering the market. She mistook activity for progress. She failed to understand that in investing, often the most profitable action is inaction. The data is clear on this point. The more an investor trades, the lower their returns. The constant buying and selling, driven by the bias for action, is a tax on performance. It is a slow bleed that drains the lifeblood from a portfolio. The most successful investors are not the most active, they are the most patient. They have the discipline to sit still, to do nothing, to let their investments compound over time. They understand that the market rewards patience, not hyperactivity. They have mastered the art of doing nothing. This is perhaps the hardest lesson for a smart, driven person to learn. It goes against every instinct, every fiber of their being. But it is essential for success. You must learn to resist the siren song of action. You must cultivate the discipline of patience. You must understand that sometimes the smartest thing you can do is nothing at all. Let the market do the work for you. Let the power of compounding work its magic. Be a patient gardener, not a hyperactive trader. Plant your seeds, tend to them carefully, and then have the patience to let them grow. The bias for action is deeply ingrained in our evolutionary psychology. For our ancestors, the ones who acted quickly in the face of danger were the ones who survived. The ones who sat around and contemplated the situation were the ones who got eaten by the saber-toothed tiger. This instinct for action is still with us today, and it is a powerful force. But the modern world is a very different place from the African savanna. In the world of investing, the saber-toothed tiger is not a predator that you can see and fight. It is a silent, invisible force that preys on your emotions. It is the fear of missing out, the greed for quick profits, the anxiety of uncertainty. To fight this predator, you need a different set of skills. You need the ability to be still, to be patient, to be disciplined. You need to be able to sit on your hands and do nothing, even when every instinct in your body is screaming at you to act. This is not easy. It requires a level of self-control that is rare in our hyperactive world, but it is the only way to succeed in the long run. The market is a marathon, not a sprint. The winners are not the ones who run the fastest, but the ones who have the endurance to keep going day after day, year after year. And the key to endurance is patience. It is the ability to stick to your plan, to ignore the noise, to ride out the storms. It is the understanding that the race is not won in a single day, but over a lifetime. So these are the 5 fatal mistakes that I have seen derail even the most intelligent of investors. The illusion of control, the poison of overconfidence, the seduction of the narrative, the failure to diversify, and the bias for action. They are not mistakes of intellect, but of psychology. They are the traps that our own minds set for us. To succeed in the market, you must not only be smart, but also wise. You must understand not only the market, but also yourself. You must cultivate the intellectual humility to accept uncertainty, the discipline to be patient, and the wisdom to know when to do nothing at all. This is the path to long-term success. It is not a path for the arrogant or the impulsive. It is a path for the thoughtful, the patient, and the humble. It is the path of the mathematical thinker, the quantitative investor, the one who trusts the data, not the narrative. It is the path that I have followed, and it is the path that I commend to you. The journey of investing is a journey of self-discovery. It will test your intellect, your emotions, and your character. It will force you to confront your own biases, your own fears, and your own limitations. It will teach you more about yourself than you ever thought possible. But it is a journey that is worth taking, because at the end of the road lies not just financial freedom, but also a deeper understanding of yourself and the world around you. It is a journey that will make you not just a better investor, but a better person. So I urge you to embrace this journey. Embrace the challenges, embrace the uncertainty, embrace the opportunity for growth. And remember, the market is a great teacher. It will teach you humility. It will teach you patience. It will teach you wisdom. All you have to do is be willing to learn. If you have found this discussion valuable, I ask that you like this video and leave a comment below. More importantly, I want you to write one sentence in the comments section describing how you will apply the primary lesson of this video to your own investing life. The act of writing it down will crystallize the thought and make it a part of your own mental framework. Thank you for your time.